When things get tough, people move to the US dollar and they move to gold and silver.
The DXY has strengthened since February. Why is that?
Copper's acting like something that has to do with the real manufacturing economy, and gold is acting like a financial asset and a currency hedge.
Gold and silver and the platinum and the PGMs have had a tremendous 2025, peaking around early 2026. Our next guest, Jeff Christian, called the rally, and he's correctly predicted the average prices for these metals in the last couple of years. Let's take a look at what his outlook is this year and how he's revising his outlook given the drawdowns in prices between gold, silver, and platinum that has transpired since the end of January. Welcome back to the show, Jeff. Good to see you as always.
David, it's always great to talk with you. You ask
Jeff
good
Christian,
questions.
Well, you give us good forecasts and good information, which is what's important for us investors. Jeff Christian is the managing director of CPM Group. Of course, you can check out his last interview, linked down below for Jeff's last appearance on our show. Jeff, let's revisit your call last year. Now, the average price of gold and silver, how have these changed since late January? You've been calling for higher gold and oil, higher gold and silver prices for quite some time. $5,000 happened this year for gold, and ever since then it's corrected about 30%. Silver dropped about 40%. This looks like the beginning of a 2012 style crash, is the analysis of a lot of people on my show. Is that your view?
No, it's not really our view. I mean, we've done that, and a lot of our clients have been asking, so were these the peaks? And partly it was because we were saying that we thought gold, silver would peak around the period 2024, 2027. When we saw the prices rise as sharply as they did, the natural thing is, okay, is this a cyclical peak? And do we go into either a 2012, 2013 decline, 1980, 81 type of decline? You've seen it over and over again. And our answer, our discussion, our analysis is that no, we're not there. That this is more of a temporary type of thing, similar in some ways to what we saw in the middle of 2025. If you go back to 2025 and you look at it, prices were very strong in the first 3 or 4 months of the year. Then they basically consolidated in a sideways pattern from April, May into and through August. And then at the end of August, they started rising, and they rose very sharply from the end of August until the end of January. And we're looking at 2026 as more like 2025 than 2012 or 2012, 2013. So we're looking at this as a decline from very high levels into a very volatile sideways consolidation period for gold and silver, with a downward bias, which we've seen over the course of April, May, February through June. And then we're looking at lower prices for platinum and palladium. We're more negative about the price prospects for platinum and palladium, although we do think that the prices at some point in the next few years could rise sharply. So we're looking at what we're seeing in terms of recent price weaknesses in gold and silver as just moving into a volatile sideways consolidation pattern. And our expectation is that the prices will start rising again in the final 4 months of this year into 2027, because the macroeconomic and political environment that drives investment demand hasn't gotten better. And our expectation is that while there has been some temporary improvement economically and politically, we think that by September things get worse again.
Jeff, the interest rate, we have to talk about that. The Fed funds rate is expected to go higher, not lower this year, given the macro conditions, given higher inflation. Do you expect, though, that higher interest rates may put downward pressure on precious metals?
Well, they already have. I mean, and higher interest rates is definitely a headwind that we've seen to gold, silver, platinum, palladium, copper, and other metals prices over the last 4 months or so, and the expectation of higher interest rates yet to come. But that's a part of a broader headwind, which is we're also seeing we're seeing stronger economic conditions than a lot of people thought, than the market consensus thought. 2%, 2.1% real GDP in the United States in the first quarter. Relatively strong business investment and consumer spending, consumer borrowing, even with higher interest rates. So we're seeing a stronger economic environment, which is something of a headwind to precious metals, as well as upward pressure on interest rates due to that stronger economic environment, also having an effect on as a headwind for precious metals. But we don't see it as something that's going to be so devastating as to drive gold and silver prices into a cyclical decline.
Yeah. And when you look at the way that these metals have behaved in the last couple of months, one may draw the conclusion that there is another force that has been pushing all of them in the same directions, up and down. And it's not particularly just a gold story that gold peaked around January, or a silver story that silver peaked around January. Platinum has also seen similar movements. And if I overlay this is something you and I have discussed before, but nothing has been more apparent than the correlation close to 1 over the last year between all these metals. Well, why is that?
It's because the price is determined primarily by investor demand, and the short-term price is determined by short-term investment demand, which is manifested in ETFs and in futures and forwards and options, as well as physical metal. And then the longer-term price is determined by investment demand, which is manifested more in physical markets. And those investors, many investors tend to lump not only precious metals, but other metals too. So you see a strong correlation between copper prices and aluminum prices and precious metals prices too. So what you see and what you have seen is, for example, in the last 4 months of last year and the first month of this year, you saw a lot of investors adding to their ETF and futures and options long positions across the metals: gold, silver, platinum, even palladium, copper, aluminum, nickel. And then since January, you've seen a big liquidation in those ETF and futures positions, as some of the shorter term investors said, hey, we did very well over that 5-month period. Now we think it's time to take profits. If you see the prices stabilize the way we expect them to over the next 2 months, then you have a situation where those investors may return on the long side over the final 4 months of the year.
Before we continue with the video, let's talk about a company that's building serious gold leverage for the long term. Our sponsor today, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colamac are among the largest undeveloped gold sites in the country. The Tower project alone could be worth $2.5 billion after tax at a $3,200 gold price assumption. And if prices go higher, so does its value. Colamac spans over 1,000 square kilometers of greenstone deposits and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. With a seasoned team, Stellar Gold is one company to watch. Scan the QR code here on screen or visit stellargold.com/David Lin to learn more. I like to talk about some of the stories or narratives that people have assigned to why gold and silver have fallen the way they did. One of them is the fact that apparently central banks have not only stopped buying silver and gold, well, gold in particular, but also has begun selling gold in large quantities. Take a look at this story. For example, Turkey sold its gold reserves in the most amount that they've ever done so in the country's history over the course of April, I believe. Turkey is a net seller. Russia has also been a net seller. There's all sorts of reasons as to why they could have done this. Some say they did it to prop up their own currency. Now, can you just evaluate, first of all, the accuracy of this data that's been circulating online? And second, if it is indeed true that Turkey's been selling gold, why they've done that? And I like to know whether or not that's a leading indicator for other central banks to do the same.
Right. The answer to the second question is the best and most important. And the answer is Russia and Turkey's sales are not indicative of what other central banks would do. So then you have to say, okay, what about central banks? And I will say this. There has been a sharp increase in the amount of bad information being circulated about central bank gold purchases and sales. But so you have a lot more noise, and you have a higher noise to sound ratio in the central bank gold data right now. But if you look at the central banks buying, yeah, there were a lot of central banks that bought in the first quarter, and then they pulled back as the price was declining, sort of waiting to see how low prices will go before they buy again. But if you look at the central bank selling ledger, it's Russia and it's Turkey. And those are very specific situations. Russia is Russia. They are selling gold because they need money both to finance their government operations and to finance their war effort, right? And they have been buying and selling gold back and forth ever since they attacked Ukraine in February of 2022. Turkey is a different situation. And one of the things that you've seen in Turkey, Istanbul is a major gold trading center. It has, over the last 2 or 3 decades, lost some of that status to Dubai. And Dubai has become a much more important entrepot for gold and silver coming into the Islamic markets, all the way from Morocco to Indonesia, as well as the South Asian markets, India and other countries, right? Mm-hmm. Dubai was cut off when the United States and Israel attacked Iran. Airspace was shut down. You had daily flights between Dubai and Mumbai, Dubai and Hyderabad, bringing in gold bullion into India and other countries, and taking scrap out of India to Dubai to be refined. When Dubai was shut down as a trading center, and it wasn't just gold and silver, it was other goods and that were coming through Dubai into other countries. Istanbul, the gold and silver markets pivoted to Istanbul. And Istanbul's gold market simply didn't have enough metal readily available to accommodate the increased trading volume. So the central bank said, we will sell you some gold and we will lend you some gold to give you, the Istanbul gold market, the liquidity you need. Part of it was also because it's so much trading, not just again gold and silver, but other goods and services were going through Turkey. There was a need for foreign exchange by the part of the Turkish government because there were an increase of imports that needed to be paid for. But the primary thing was to provide liquidity to the Istanbul gold market. That tells you, and you saw they've already unwound a lot of their leases because the liquidity improved. And I'm not sure that they've actually started to buy back their gold because they can wait on that. But the fact that what the Central Bank of Turkey, of the Republic of Turkey, was doing was providing liquidity to the Istanbul market. That's a unique situation. It doesn't translate to other countries. So yeah. We don't think that you can look at what was happening in Turkey since the United States attacked Iran and say, oh, well, if Turkey's selling gold, other central banks are going to sell. Turkey is a special situation.
I see. Now, long term, do you think that the closure of the Strait of Hormuz and the Iran war overall has prompted central banks around the world to look into gold more for long-term holdings and perhaps replacements to the U.S. dollar in the foreign reserves? The logic here is that as protectionism rises worldwide and as critical choke points become the focal point of people's attention after the Iran war has happened, now countries are going to start looking more inwards and want to insulate themselves from potential cutoffs in other choke points. In other words, people are going to be more independent, trade potentially less, and therefore require more gold in their reserves. Does that logic make sense to you?
It does make sense, but you have to put it into context. It's not this black and white extremism that you hear from a lot of people. It's a matter of degrees. I mean,
Yeah.
I started working in precious metals and commodities in the 1970s. And at that point, we were 5 years, 8 years into a floating currency exchange rate system where the dollar gold standard had ended in 1971. And you saw a dominance in the US dollar in terms of paying for goods, services, and capital flows between countries. And everyone, by the late 70s, central banks said, okay, this too shall pass, right? And we will move to some sort of new international currency regime. We don't know what it is. And I started working with various central banks in 1981, talking about what could be a future international currency regime and what would be the normative role of gold in central bank monetary reserves in such an environment. And this discussion has been going on for now 47 years, 46, 47 years, right? So it's a continuation of a long time thing. No one should have ever been surprised that central banks were diversifying away from gold in the part of industrialized countries that had 80, 90, 95% of their monetary reserves in gold, or away from the dollar, where you had newer countries, the Asian tigers, China, Russia, Brazil, and other countries that had 80, 90, 95% of their monetary reserves in US dollars. Now, over the last several years, we've seen an acceleration in efforts to diversify the reserves, and we've seen an increased portion of monetary reserves in gold. And I will say this, most of the increase in the amount of gold, the value of gold monetary reserves has been due to price appreciation as opposed to actual physical purchases by central banks. Obviously, central banks have been buying gold, about 10 million ounces a year, not 20 or 30 like some people say, but about 10 million ounces of gold a year have been being bought on a net basis by central banks. But the biggest portion of the increase in the value of central bank monetary reserves in gold has been due to the price increase from $1,200 to $4,036 as we speak. You've also seen a very big increase in other currency reserves as a percentage of total monetary reserves. The dollar has gone from about 62% to about 57% of monetary of foreign exchange reserves. The euro has gone from about 29% to about 17%. So it's lost even more market. But what you've really seen is gold, other currencies, and those other currencies are there. So this is part of this long-term, it's half a century now, where central banks have been saying we need to diversify our monetary reserves. And part of that diversification is all those other currencies. And part of that diversification is gold. And that's really what you're seeing. Now, you look at it and you say, okay, there are limits to the extent to which you can add those other currencies and gold to your monetary reserves, because these are smaller markets. There's less liquidity. Interestingly, as I said, if you look at the gold and the increase in gold as a percentage of monetary reserves, the bulk has been because of gold appreciation.
That's
if
right.
you look at the other currencies, it's been the addition of those currencies, because in many cases, those currencies have been declining in value over this period of time. So you've got central banks saying we need to diversify. The Trump administration has clearly accelerated the desire to get away from dollars. And it's also clearly accelerated the ability to do that. Because if you look at it, the United States has lost a lot of international trade and a lot of international capital flows to other countries. If you look
Could,
at China, China's trade last year with the United States declined double digits.
can we
But
just examine that
China's
statement?
trade with other countries rose more than 20%.
Yeah.
So you're seeing the international monetary and financial system move away from the dollar, partly because of the hostile international relations of the Trump administration, and
Yeah.
partly because of a breakdown in globalization.
So that makes sense what you're saying, the desire to move away from the dollar, yet the data, at least the chart that I'm showing here, the DXY is not supporting that, at least in the short term. The
Right.
DXY has strengthened since February. Why is that?
Because when things get tough, people move to the US dollar and they move to gold and silver. So it's not unusual that you would see the dollar rising, even though the United States is the instigator of a lot of the political and international tensions right now. It's still the most liquid market. And if you look at it economically, the United States economy is doing far better than the European economies. And again, the euro is the second most liquid currency that you have. Once you get away from the dollar and the euro, you have a very steep decline in the liquidity of other currencies. So when you start saying, well, where do I put my wealth? You need a market that has a sufficient liquidity to hold that. And the US dollar, and to far lesser extent, the euro, are the places where you have that liquidity. So what you've been seeing since April is strength in the US dollar, because it's the place where you put money when things look really bad.
Okay. I'd like you to evaluate, please, a few articles. This one from Reuters: gold ETFs could see outflows rising on bets that the Fed will tighten monetary policy. Here it says ETF flows are closely linked to U.S. monetary policy as reflected in the buying and selling of physically backed products. Says an analyst here. While recent inflows suggest selling pressure may be easing, ETF demand is likely to remain less supportive than it was in 2025, analysts at ING said. So we already talked about your outlook for gold, but I just want to bring this to ETFs in particular. If it's indeed true that we have a less supportive environment for gold ETFs in particular, does that have any impact on the underlying price itself, or is that a reflection of the underlying price moves? How do ETF demand, basically, how does ETF demand impact spot price gold?
Yeah, it's very important. I mean, we've been talking about this in our own videos. Gold ETF holdings declined 2.8 million ounces from the middle of May, when the FOMC indicated, hey, maybe we're going to be raising interest rates, to June 25th, last week, right? So you have seen that go. Now, I spoke earlier, I was talking about short-term investors versus long-term investors, and short-term investors will tend toward the ETFs because they're easy to buy and sell. The transaction costs are less, and other things. Gold ETF investors fall into various categories. And a lot of gold ETF investors, especially since August, September of last year, have not been traditional long-term gold investors looking to hold gold on a long-term basis and paying those prices and arranging for physical purchases and storage. They have been shorter-term, opportunistic, non-traditional gold investors. There are traditional gold investors who invest in the gold ETFs, but if you look at the ETFs and say, well, this is what gold investors are doing, you're misreading the gold market, because ETF investors only represent probably about 10% of the global physical gold market. And that other 90% is much more important on a long-term basis and tells you where it's going. So we look at, that, I'm sorry for all that preamble, but to answer your question, we look at trends in gold ETFs as a short-term indicator. We saw it rising September through January, and we said, this is bullish. We've seen it declining since January, mostly in May and June. That's bearish. And our expectation is that when the economic and political environment starts being perceived by the financial market consensus as being more hostile after August, we think that gold ETF investors will return. They're very opportunistic.
One thing that has puzzled me slightly is the divergence between copper and gold. Take a look at my chart here. Right now, you're seeing copper on the screen. I'm going to overlay this with gold. And what you'll find immediately is a more or less close correlation, not just on the long term. If you zoom out, they've both moved together. But I think over the past year, that relationship has gotten closer together. Now we see a divergence between these two metals starting early May as copper continued to rise to new all-time highs. It's fallen off its highs somewhat since the last couple of weeks, while gold has continued to fall since early May. And then what I did was I overlaid copper with the stock market and just the S&P 500 as a point of reference, and that has held a much closer correlation all throughout the year into now, since May, than gold did. I wonder why copper is trading alongside stocks more than it is to other metals.
Because copper is an industrial metal that's used in fabrication of products. And gold is much more a financial thing. I mean, obviously, if you look at the bulk of gold usage, jewelry, decorative objects, and investment demand. Copper is an industrial metal. And the stock market and the copper price are reacting to investor expectations, investor realizations that the economy is in better shape than they had thought, and in investor expectations that the economy will continue to be better, at least for the next several months, than they had thought. So copper is acting like something that has to do with the real manufacturing economy. And gold is acting like a financial asset and a currency hedge.
To what extent is Dr. Copper actually earned as a name? In other words, how accurate is copper in forecasting economic growth and inflation expectations?
I have always poo-pooed the idea of Dr. Copper. You can always find times when copper prices are a precursor to strong economic conditions, but you can also find times when it isn't. So, and I won't bore you with the historical details, but you can look at the mid-1980s, you can look at the mid-1990s, you find these periods of time. I don't think that copper is a particularly good precursor of overall economic activity. It is a good barometer of what investors think future economic activity will be. But as you and I know, investors often get it wrong.
Okay, and two more pieces of, rhetoric I'd like you to address. You and I haven't spoken much about silver's decline since a couple months ago. So silver, as you know, climbed, alongside gold. I'll just put silver on the screen here, to record highs early in the year. And then all of a sudden, we had this massive red bar with gold dropping double digits. Silver dropped 30% in a single day. Of course, all sorts of theories arose as to how that happened. JP Morgan once again became the butt of the joke, so to speak, or the main culprit as to who shorted silver. Now, this obviously looks institutional. Whether or not JP Morgan was behind it, who knows? But the point is, banks accumulated large short positions, according to this Reddit post and many others like it, right before the correction. Surely all of them moved, all gold, all of these metals moved together. So it was, quote unquote, orchestrated somehow. And the question is, what prompted this selling? Do you have any idea or indication as to,
A lot of these people have a fundamental lack of understanding of financial markets. And JP Morgan, the bulk of its commodities transactions are for clients because it is a futures commission merchant. So it's not that JP Morgan said, let us sell 10 million ounces of silver. It is that JP Morgan is one of the few major future commission merchants that's still in business, because a lot of companies have gotten out of that business. A lot of banks and trading companies no longer work with investors and others. So when you see JP Morgan liquidating 10 million ounces on the futures market, they're doing most of that for their clients. And people have some sort of religious belief that prohibits them from understanding that. And they have a similar religious belief that prohibits them from picking up a basic book that says Commodities Market Trading 101. Let me learn about how these markets actually work. So there's this enormous ignorance built into commentary about commodities, and it combines with this puritanical thing. You see it with the people you interview. It's got to be a depression or hyperinflation or both. No one ever stops to say, you know what, the probability of depression in the next 5 years is like 0.5% probability, and the probability of hyperinflation is 0.5% or less. I think it's actually 0.15% on both sides. And the most likely future scenario is economic activity weakens, inflation stays high. It's not hyperinflation, it's not a depression, it could be a recession. But you see there's this religious puritanical thing. You can only see depressions and hyperinflation in so many people's comments about the economy and gold and silver. And that's like saying, I'm going to ignore 99% of reality.
I think the conclusion here is it's more nuanced than just banks dumping silver randomly on a Sunday. I want to just draw your attention to my last point, which is critical minerals. Now, the choke point, which is the Strait of Hormuz, has been top of mind for traders all around the world, especially oil traders. Right. But how does it impact other commodities outside of oil and precious metals we already talked about? The strait is once again closed. 2 tankers have been struck over the last couple of days. Now the question is whether or not it's going to open anytime soon. The question is which critical minerals, if any, would have a longer term impact from this closure, assuming it doesn't reopen anytime soon.
I sort of backed away from looking at the individual metals, and I just look at the critical mineral issue more from a high-level government policy, economic effect on nations. And I think that, let's be realistic. We are 20 or 30 years, depending on where you put the starting point, into a trend toward deglobalization and reduced international cooperation among countries. And in that kind of environment, nations and governments have become much more tribalistic. And rather than say we really need to rebuild our global cooperative systems because they worked so well in lifting people up economically in the 70s, 80s, and 90s, governments are saying we need to worry about our own stuff. And there's a tremendous misallocation of funds into trying to build domestic supply chains that ultimately will cause a lot of the mines, like if you see this in particular in the United States, or at least we see it in the United States, a lot of money being poured into mines that probably will never develop and produce an ounce or a pound or a ton of material because they're sub-economic deposits. But the governments would rather throw this money at these deposits that are controlled by donors to the politicians than spend the money on A, research, or B, finding ways to rebuild that international cooperation that worked so well for 30 years.
Okay, then final question of the commodities we discussed so far, or perhaps anything else that you like to cover or has covered. Which of these metals and commodities are you most bullish on for the remainder of 2026?
Gold and silver. Gold and silver I am most bullish on. Again, we think that the prices consolidate over the next 2 months, but then rise in the final part of this year.
So is it fair to say? Is it fair to say gold has found a bottom around 4,000?
No, I think that gold, our most recent ultra short-term uh, report
Yeah.
says that we think that the price is broken below 4,100 a couple times over the last few weeks. It's down below it today. We think that there's a lot of technical selling pressure with a target around 3,800. And I wouldn't be surprised to see the price spike down to that level. There are other people looking at 3,500. I don't think that we'll see that because while there are some improvements economically and politically, we're still in a very treacherous, high risk environment. So I
Sure.
think that at 3,800, you'd probably see a lot of short term buying and short covering coming into the market. So I'm not quite convinced that the selling's over.
Mhm. Sorry, I cut you off about copper. You were saying something about copper.
Yeah, that's okay.
Okay. All right. Let's find out more by reading Jeff's work. You've released a couple of your books this year. Please tell us where we can find them.
You can go to our website, cpmgroup.com. These books are available as ebooks. You can buy them. The Gold Yearbook came out in late March, and it's available on our website. The Silver Yearbook came out in late May. It's available on our website. The Platinum Group Metals Yearbook will come out on July 21st, and you can pre-order that on our website. And then there's other research that's available there too.
All right. Thank you very much. Appreciate it, Jeff. Good to see you as
So
always.
always a pleasure.
And thank you for watching. Don't forget to follow Jeff in the links down below. And don't forget to like and subscribe.